Looking for a steady income? Real estate investment trusts might just be the answer. These companies deal with real estate assets like office spaces, shopping centers, etc. What's great about REITs is their tax advantages. They're required to distribute most of their income to shareholders, keeping them exempt from corporate taxes. This means higher yields for investors compared to regular stocks. They also offer reliable cash flow thanks to rental income. So, without a doubt, investors can expect a decent return if their properties stay occupied. And yeah, sure, REITs took a hit recently as interest rates rose, with some investors favoring bonds. But with rates starting to dip, REITs are becoming attractive again. So, which are the best REITs to invest in? And why? If you're looking for some solid income for 2024, these REITs are worth a look. But first, as we journey through 2024, the Federal Reserve's approach to managing inflation is breathing life into the REIT sector. REITs heavily rely on the debt market for their operations, so lower borrowing costs due to the Fed's policies are beneficial. Moreover, with low interest rates, REIT valuations are likely to rise. One of the key attractions of REITs is their regular dividends, and with potential rate cuts in the following months, REIT dividends are expected to be more appealing compared to yields from fixed income and money market accounts. Beyond these overarching factors, the economy is gradually recovering from the pandemic slump and showing resilience. A positive job market outlook adds to the optimism. Demand for specific real estate sectors like data centers and essential asset categories remains strong, further supporting REIT's momentum in 2024. Sectors in the spotlight. In 2023, the real estate market held strong, and the trend is continuing in 2024. Retailers are gearing up to lease more physical store spaces while expanding their omni-channel retail models. Many retail REITs are shifting focus towards developing mixed-use assets, capitalizing on areas where people prefer to live and work. While the U.S. industrial real estate market is anticipated to stabilize, the demand for such spaces is expected to remain strong. This is fueled by improvements in various industries and continuous growth of the e-commerce market. Furthermore, companies' efforts to enhance supply chain efficiencies will fuel leasing activities in logistics infrastructure and efficient distribution networks in the coming months. In the residential real estate sector, the steep costs of homeownership in many markets compared to renting, coupled with the flexibility of renting apartments, will drive demand and maintain high occupancy rates despite increased supply. Specialty sectors like self-storage, data centers, medical offices, life sciences facilities, and senior housing have experienced strong demand in recent years, leading to steady investments in these alternative asset classes. In the digital age, there continues to be a significant demand for interconnected data center spaces from enterprises and service providers as they incorporate artificial intelligence, AI, into their strategies and operations, advancing their digital transformation initiatives. With AI implementation becoming more widespread, the sector is poised to attract more investments in 2024, bolstering the growth prospects for data center REITs. So, what are the best REITs to invest in 2024? Let's begin with Host Hotels and Resorts, Inc. Headquartered in Bethesda, Maryland, this one is a prominent hotel REIT with a portfolio comprising 77 hotels boasting 4,200 rooms situated in major U.S. markets. Remarkably, Host Hotels has been a member of the S&P 500 since 2007, standing as the sole hotel REIT in this prestigious index. Its portfolio includes renowned hotel brands such as Marriott, Hyatt, Four Seasons, and Hilton. But what makes this REIT a winner in 2024? In a significant move on December 15th, Host Hotels and Resorts declared an 11% hike in its fourth quarter dividend, raising it from 18 cents to 20 cents per share, and a special dividend of 25 cents per share. Due to this, analysts have expressed optimism about Host Hotels. Jefferies' David Katz maintains a buying rating and increased the price target from $21 to $24, suggesting a potential upside of 23.5%. Similarly, Wells Fargo's Dory Keston reiterated an overweight rating and lifted the price target from $20 to $22. Host Hotels also demonstrated a remarkable 17% increase in revenue per available room from 2017 to 2023, and it anticipates further RevPAR growth in 2024, aligning with the expectations of many other hotel REITs. Despite its strong performance, Host Hotel remains undervalued, with a price-to-funds from operations ratio of only 10.21. Although its dividend yield of 4.06% is slightly lower than desired, the recent quarterly dividend hike and a modest 41% payout ratio indicates the potential for another dividend increase in 2024. Moving on, we have the Healthcare Realty Trust, Inc. Healthcare Realty Trust, Inc., headquartered in Nashville, Tennessee, is a healthcare real estate investment trust with a vast portfolio spanning 697 properties and covering 41 million square feet across 35 states. Established in 1992 with 21 facilities, it has since evolved its delivery model, with 72% of its properties now being multi-tenant medical outpatient service buildings located on hospital campuses or other healthcare facilities. As of the third quarter of 2023, its occupancy rate stood at a robust 90%. So why does the company have a positive outlook for 2024? The company's strategy for 2024 is to increase exposure to higher growth, multi-tenant medical outpatient buildings on campuses while utilizing sales proceeds to fulfill development obligations and repay floating rate debt. Due to this, J.P. Morgan's Michael Mueller upgraded the stock from neutral to overweight with a $19 price target, citing expected improvements in relative valuation due to recent occupancy gains. Its annual dividend yield stands at a healthy 7.15%, with a moderate payout ratio of 78%, showing positive performance in the last 2 months of 2023. It achieved a total return of 22.23%. This indicates an improving healthcare REIT with gains in occupancy and reduction in debt, suggesting promising performance ahead. Up next, we have the Boston Properties, Inc. Headquartered in Boston, Boston Properties, Inc. is a prominent office REIT boasting 190 properties covering 53.5 million square feet, primarily concentrated in 5 major cities: Boston, Manhattan, Washington, D.C., San Francisco, and Seattle. It proudly claims the title of the largest publicly traded developer, owner, and manager of premier workplaces in the United States, and is a member of the S&P 500 index. But how has it been performing? With a robust 90.4% occupancy rate and a weighted average lease term of 7.5 years as of the end of the third quarter, Boston Properties stands out favorably among its peers in the office REIT sector. Approximately 10% of its office properties cater to life sciences, mitigating the risk of employees transitioning to remote work. Notable tenants include industry giants like Google, Microsoft Corp., Biogen Inc., Fannie Mae, and Bank of America Corp. Analysts have recently expressed bullish sentiments towards Boston Properties. Piper Sandler's Alexander Goldfarb maintained a neutral rating but raised the price target from $60 to $77, while Jefferies' Peter Abramowitz upgraded the stock from hold to buy and increased the target price from $57 to $80. With a P/FFO ratio of 9.92, Boston Properties still offers potential for further price appreciation. Moreover, its dividend yield of 5.44% and a conservative 32.82% payout ratio make it an attractive investment option. Amid declining interest rates and a growing trend of companies returning to work or adapting hybrid models, Boston Properties appears poised for success in 2024. Cousins Properties, Inc. Headquartered in Atlanta and established in 1958, it operates as an office REIT with a focus on high-growth Sun Belt markets. Its portfolio comprises 19.1 million square feet of Class A office towers, primarily constructed after 2004, boasting modern amenities such as fitness centers, meeting rooms, and cafes. This allows Cousins to command rents approximately 24% higher than the Class A average in key markets, including Atlanta, Austin, Charlotte, Dallas, Phoenix, and Tampa. With an occupancy rate of 91.1%, Cousins outperforms many of its office REIT peers. Cousins' top 25 tenant portfolio features prestigious names like Bank of America, Briggs & Stratton Corp., HD Supply, Deloitte, and the American Cancer Society, with a weighted average lease term of 7 years. The company maintains one of the strongest balance sheets within the office REIT sector. So what are analysts saying about this REIT? Well, analysts have shown optimism towards Cousins Properties. JP Morgan's Anthony Pallone upgraded the stock from neutral to overweight and raised the price target from $26 to $27, while Trust Securities' Michael Lewis maintained a buy rating with a price target of $27, revised down from $28. Four Corners Property Trust, Inc. This one operates at a diversified REIT, primarily focusing on owning net leased properties in sectors like restaurants, medical and dental services, automotive services, and other retail establishments, mainly in the Sun Belt region. Notably, it has been one of the fastest growing REITs in recent years. Founded in November 2015, Four Corners initially comprised 418 restaurants spun out from Darden Restaurants, Inc. While many Darden properties were subsequently sold off, Olive Garden and Longhorn Steakhouse restaurants still contribute about 51% of Four Corners' total rent. Four Corners has aggressively expanded its portfolio through strategic acquisitions, carefully adhering to acquisition standards. Its portfolio includes 1,106 long-term leased properties encompassing 148 brands across 47 states. Impressively, the company boasts a robust occupancy rate of 99.8% and a weighted annual lease term of 8 years. In late December, Four Corners made a notable acquisition, including 2 Popeyes Louisiana Kitchen properties and 2 Tire Discounters properties. These acquisitions contribute to the company's ongoing revenue growth, which has seen an increase for 13 consecutive quarters and is expected to continue that way in the foreseeable future. Impressive, right? Realty Income Corporation. It's a triple net lease REIT specializing in single-tenant, freestanding commercial properties leased to retailers across various defensive industries, as well as operators of industrial and gaming properties. With a market cap of around $42 billion, Realty Income boasts a vast portfolio spanning 262.6 million square feet, comprising over 13,000 commercial properties situated across all 50 states of the U.S., as well as in the United Kingdom, Spain, Italy, and Ireland. Their properties cater to approximately 1,300 tenants, representing 85 different industries, with retail properties constituting 82.6% of the portfolio and industrial and gaming properties at 13.1% and 2.6% respectively. Realty Income strategically targets retail properties in recession-resistant and e-commerce-resistant industries such as grocery stores, convenience stores, and dollar stores. These sectors collectively contribute significantly to their annual rent, with grocery and convenience stores being the largest segments, accounting for 11.4% and 10.6% of their annual rent, respectively. Maintaining an impressive 98.8% occupancy rate and the average lease term of approximately 9.7 years, Realty Income boasts an investment-grade balance sheet with an A credit rating and robust debt mechanics. The company pays a monthly dividend, a tradition upheld over its 54-year operating history. It has earned the esteemed title of a dividend aristocrat by consecutively increasing its monthly dividends for 29 years, totaling 105 consecutive quarters. Lastly, we have the Rexford Industrial Realty, REXR. This one specializes in acquiring, redeveloping, and operating industrial properties exclusively within Southern California, SoCal. With a market capitalization of nearly $12 billion, Rexford Industrial boasts 371 industrial properties covering approximately 45 million square feet across the SoCal region. Concentrating their entire portfolio in SoCal is a strategic choice due to the region's unique industrial market dynamics, characterized by a persistent supply-demand imbalance. SoCal, being the largest industrial market in the U.S., is home to a vast economy comprising approximately 22 million residents and over 600,000 businesses. However, the availability of developable land is limited due to natural barriers, such as mountains and the oceans surrounding the region. Hence, Rexford Industrial's decision to exclusively focus on SoCal is driven by the region's size and favorable market characteristics. As of the end of the third quarter, Rexford reported an impressive average same-property portfolio occupancy of 97.8%. Since 2014, Rexford has demonstrated robust performance, achieving an average adjusted funds from operations growth rate of 12.89% and an average dividend growth rate of 13.08% over the past 8 years. Analysts foresee rapid growth in AFFO, projecting a 16% increase in 2024 and a 19% increase in 2025. So, which of these REITs caught your attention? And well, are you ready to get into the real estate market? Share your thoughts in the comments below. And don't forget to give this video a thumbs up and subscribe to our channel for more insightful content. Until next time, happy investing.